Hi, everyone. Welcome to our show today, our webinar today. We are very excited to have Eric Freeman. Eric is a CPA, good friend of mine, who I ask free advice to whenever I get him in the party. So Eric kind of currently works for BeachFleischman, which is a pretty prestige tax strategy firm. And Eric is at his young, tender age. He's actually already a partner over there. Very welcome to our show today, Eric. Eric, why don't you tell us a little bit about yourself? And then we're going to dive into a lot of questions that we have received from our viewers and our investors over here to resolve some of the issues questions they have. Yeah, Eric, go ahead.
Yeah, thanks Elisa for having me today. I'm really excited to talk to everyone today, especially because all of you submitted all these questions. So that was great. I know that everyone will be interested in some of the topics we bring up, but a little more background on me real quick. Like Elisa said, I'm a partner at a large locally owned tax firm, BeachFleischman. We're like a top 125, 125th largest firm in the US. So we have offices in Phoenix, Tucson, and we do all kinds of work. I personally specialize in real estate. That's my forte, but I have some experience in other areas, mostly like hospitality, some international work, and other miscellaneous things. But our firm basically touches every industry, does audits. We do a lot of consulting, tax planning. Our niche work is basically strategy. It's strategy and planning first, and then all the compliance and tax returns come second, just as a necessary thing that you have to do. So I've been practicing for over a decade now, from Arizona originally, and so this is kind of my passion. I actually invest in real estate on my own as well. So I hold it near and dear to my heart, trying to really make the best of it, both from an investment and a business decision. But then once you've attacked it from those angles, then figuring out what the most tax efficient way is to carry forward with it. So really excited to dive into some of these questions.
Yeah, awesome. Well, first of all, I'm going to ask a little bit more generic a question, and one that every single year never gets old. What is in the works currently that you see in the Congress, et cetera, getting passed with tax code, with tax changes that's coming our way that real estate investors and investors should kind of pay attention to?
Yeah, definitely. So we've had so many changes, as you might be aware, in the last few years with COVID happening and just tax law changes over and over. But Biden doesn't have a proposal there's anything immediate changing from what we already knew earlier on in the year at this point. So the things to watch out for are still the big thing that everyone's talking about is bonus depreciation is going down from 100% to 80%. And just to back up in case you don't know what I'm referring to, basically when you acquire a large asset, typically you have to depreciate it over X number of years. Bonus depreciation basically says you can write off the entire asset. So that's going to change, slightly less benefit. That'll affect real estate greatly, especially cost segregation studies, which we'll probably touch on. So that's the big one to watch out for. As far as, we already had the Inflation Reduction Act that was passed, I think, in September of this year. So it's new, but there's not, for the most part in there, what you're looking at is obviously they hired a lot of, or they're planning to hire a lot of real IRS agents. And so we'll see what they do, what their actual hiring looks like. But the other thing is it was really heavy on energy credits and energy efficiency and everything surrounding that. So the solar credits were extended for both residential and businesses. they were set to start dropping down from 30% credits and phasing down or getting removed completely. Those got extended, on the business side, and I believe on the personal side, those are extended another 10 years out at 30%. So that's a pretty big one. And then there's all kinds of other energy credits in there for both personal residences. If you're upgrading any of your AC systems, hot water tanks, even windows, doors, you may be eligible for increased credits going forward on that. So if you're doing any upgrades that might have some energy efficiency, definitely want to look into that going forward, because that's probably going to be a big target area for this administration for a while. And then one other thing I just wanted to mention for people to keep an eye out on, and this is more of a compliance thing, is that starting in 2024, so really basically a year from now, a little over a year from now, all LLCs are going to have to do additional reporting to FinCEN, which is the financial crimes section of the Treasury Department. And this is a big deal because for foreign reporting, foreign owners have always had to report to FinCEN. Now it's all domestic LLCs, and this is big because if you don't file these reports, they have huge penalties for LLCs. So and their percentages. So I mean, it even applies to states like, if you have an LLC in Delaware, Wyoming, or all those states where you typically don't report owners, you would have to report it to FinCEN, which is a federal organization, but it won't be publicly known, and it's probably going to be going to just a black room that no one accesses unless they have to, sort of thing. So it's more of just a hassle and trying to avoid the heavy, burdensome penalties that they could put on you. So planning wise, knowing that that is going to happen, if you're an investor in syndications and you typically set up a different LLC for each of your investments, consider setting up less LLCs for those investments to reduce that burden. If it makes sense, use just one to invest in them, things like that. Just think of ways to lower that burden.
Gotcha. Yeah, that definitely has a lot of impact for me. Same with energy credits, which is good news, but the reporting is bad news for us. Same with increase the IRS agent, because that also means potentially more audits for everybody. So that's kind of what I derived from this.
Yeah. I wouldn't worry too much about more audits though, hopefully, because I think from everything we're seeing, there's so many retiring that they need to hire more just to replace what they have. And they're so behind as it is, trying to get anything resolved with the IRS for the most part. I mean, if you've gotten notices, and just the time it takes to resolve things is so much longer because they don't have anyone, they don't answer the phones, they don't, they're just so backlogged. So
Yeah.
will some audits increase? Yeah, but very high income, or mostly like estate and gift tax returns are really heavily targeted just because there's more opportunity there. But your average middle income, low income taxpayer is not going to probably see much of an increase in audits, is my guess.
Got it. Okay, cool. We're gonna move on to some of the questions that we have. We've probably got a whopping 16 of these. So we'll try to get through as many as possible. So what are the most common tax loopholes missed by real estate investors, syndicators? Now we kind of talk about timely opportunities or adversity. Now let's kind of talk about a little bit more generically, what are the things that typically the real estate investor will miss?
Yeah, so first I wanted to talk about loopholes and just clarify the term, because you see it, I mean, I see that term everywhere. And for me, when I think of loophole, to me, that is a mistake that Congress made or Treasury made, and taxpayers are trying to take advantage of it. But the things we're talking about today, these are all intentional benefits that you get as a real estate investor. this was designed intentionally by Congress and the Treasury when these laws were passed. So it's not like you're doing anything wrong. This is actually what you're supposed to do to incentivize these activities, because real estate is very capital intensive. So with that, one of the things that changed in the last few years that a lot of people aren't aware of is the qualified business income deduction. I find that I mention that to a lot of people and they're not sure what it is, but essentially this was part of Trump's tax plan in 2018. And what this is for any pass-through entity, which includes single member LLCs though. So this could be something through an S Corp, it could be something through a partnership, it can be a single member LLC, or it can be something that's reported directly on your individual tax return. So on your Schedule C if it's a business, or Schedule E if it's a rental property. All of these can potentially qualify. And what it is it's just a flat 20% deduction off of your income from those businesses. And so how this applies to real estate is that real estate can qualify as a trade or business. So that's huge if you have positive income in some years, that you can just get this 20% free write-off. But what some people don't realize is it doesn't apply to, there's one big thing that it doesn't apply to, and that is triple net leases. So if you have single family residence and you don't do any of the, like the tenant does all the repairs, schedules the repairs, and then invoices you or something, or if you have a commercial property like a CVS or a Quick Trip, triple net, lease or ground lease, those typically don't qualify. So knowing that ahead of time, and if you can, structuring those so that maybe you are scheduling repairs or something, so you can get that deduction. That's one item. There's also grouping activities. So for real estate professionals, to be able to offer professional, just to back up, but I'm sure a lot of people kind of are familiar with this term, but a real estate professional is someone that works at least 750 hours in a real property trade or business, and they spend more than half their time in real property trades or businesses. So if it's your full-time job to work in real estate, then you probably qualify. And that's construction, development, property management, being an owner. So all of those items, even a real estate broker, all those items qualify as real estate activities. So if you spend all that time in those activities, and then you also invest, so in syndications, because we're talking about syndications too, so maybe you have some activities on your own and then you invest, well, you probably don't materially participate in all those limited partner investments. So the only way you can use those to offset your other activity is you have to make an election and group them so you can take those deductions. So it's important to be aware of that grouping election and what it means to be a real estate professional, how you can take advantage of it. Really important distinction too, I mentioned brokers, real estate brokers as qualifying. Agents do not qualify typically. So if you're just a licensed agent selling real estate, probably don't qualify as a real estate professional. But if you're the broker and you have your broker's license, you do qualify. For some reason, the court's made a distinction between those two. So that's an important one that some people don't catch and might miss. And there's really a lot of other things. I mean, a lot of people, I'm surprised, are still not doing cost segregation studies all the time. So a cost segregation study is essentially taking advantage of accelerated depreciation deductions. So generally speaking, if you buy a rental real estate and it's residential, you take the cost after removing the value of land, divide it by 27.5, and that's your depreciation deduction each year. Well, a cost segregation study takes that asset and it breaks it down into all the components that won't last 27 and a half years. So your carpeting and cabinetry, countertops, your the asphalt in the parking lots, maybe even the sidewalks and rails and exterior lighting, swimming pools, some of the landscaping, all these items can be broken out and just expensed essentially instead of taking it over time. And so I see a lot of people that still aren't taking advantage of that. And I think the reason, there's different reasons, but most of the time it's pretty advantageous. That's a big one. So those are just a couple of things that people miss sometimes, but I think there's a lot more than that, but we don't have all night.
We don't, huh? Great,
I mean,
awesome. Yeah, thank you.
I do if you all want to stay all night, but I don't think you do.
Yeah, you'd be surprised. This crowd is very interested in tax. And so now we're gonna get to second question, and I think some of these are following up questions may kind of tee into it as well, so we can get into an opportunity to go a little deeper on some of these. So one question we have is, can a LP, which is limited partner who is investing into syndication, can a LP sheltered against from a sale of an asset they invested in with net loss carryover they have occurred from cost segregation, presumably from the new investment that they're investing in, which then did do a cost segregation and generating a negative loss carryover?
Yeah. So this kind of ties into what we were just talking about with the real estate professional, but just to provide a little more context, generally by default, real estate is passive activity. And it's important to know that because passive activities can only offset other passive activities. So if you have a passive loss, you have to wait until you have passive income to be able to actually take advantage of that deduction. So with this question, if you have a loss from a K1 and you're passive in that investment, and it could be a loss for whatever reason, but in this case, let's say it's a cost segregation study. So you have this big loss, and then you have income from another K1, or maybe it's the same K1. It doesn't matter. It could be the same or a different one, as long as it's a passive activity. Then you can take that loss and offset it. You can even, if you have a sale from one, it could offset the gain on the sale too, if it's a passive activity. So say you did a cost seg 1 year and you sold that same K1 investment, they disposed of the asset a couple years later, you could use that cost seg loss carryover to offset the gain on that sale. So that's definitely something that you can do. It becomes more of a concern when you're trying to offset your other ordinary income. So wages from a job, or income from an active business that you're actually involved in, or interest and dividends from various investments. You have a hard time offsetting those unless you are a real estate professional. So yeah, you can definitely offset other passive income. I think you're on mute, Elisa.
Oh, great. Sorry. And then the key of this is that if you had any carryover losses, even from previous year, let's say we sold the property now, you could potentially use that carryover losses to defer the basically the gain that from selling of the syndication. So a good example over here would be a passive investor who's invested in syndication deals. And let's just say we made a good profit for the year and they now staring at a capital gain. And then if they reinvested that money even in that same year, then into another deal, and let's say we do a cost segregation that year, even on the following year, as long as the tax filing generates the K1 off that in the same year, that K1 that generated in the latter property that they purchased could potentially also use to essentially defer the initial one, right?
Yeah, exactly. So, I mean, you don't have to, in that case, be too concerned on timing in terms of doing the cost segregation study in the same year that you're going to have income from another, as long as the cost seg happens before. So the cost seg could happen the year before and it would still be there to offset in a future year. I would say that if you are, just to take it a step further in case this applies to anyone, if anyone is a real estate professional, that analysis now changes a little bit um, because if you're a real estate professional and you have losses and say you do a cost segregation study to generate losses, timing becomes more important because again, Trump changed the tax law so that net operating losses, which is essentially, it's just another type of carryover. So instead of a passive loss carryover, a net operating loss is basically when you're active in something. So like an example of this might be, let's just say you're a real estate professional, that you do property management, that's your main gig. And then you also invest in real estate and manage it yourself. And let's say you have income from managing property and then you do a cost that can generate a big loss, and that loss exceeds your income from the management activities. So now you have what's called a net operating loss, because in this case, you're a real estate professional.
Yeah.
Going forward, so it's great for that year, but going forward, the new law is that you can only offset 80% of your taxable income with that net operating loss. So if you go into the next year, and let's say your income is 500,000, I'm just making up a number. You have 500,000 of income, and let's say you had a carryover loss of $1 million. Well, you would think, oh, well, I have $1 million loss and I have 500 income. Great, I'm not going to pay tax. But that's not the case because you can only offset 80%. So 80% of 500,000 is 400,000. So you end up still only using 400,000 of your $1 million carryover and paying tax on $1 million or on 100,000 the next year.
Gotcha.
So when you're thinking about timing certain deductions, you don't want to create NOLs. You want to get it as close to zero as possible, but don't go too far because you want to save those deductions for future years. Because if you save them, you don't have that same limitation, if that makes sense. So
Got it.
knowing if you're a real estate professional or passive makes a big difference.
So for example, just to kind of clarify that thought a little bit, for example, in next year, when I made a 500K, if my loss was incurred in that year, then it would be possible to offset 100% versus if it was carried over from last year. And then when you say that carryover, it's marked by the K1s of the tax year that you generate, right?
Yes. Yeah. Right. It's in the tax year that you have the loss. So if it was a loss from the K1, that would be the year that you would potentially generate the NOL. But again, you can only have an NOL if you're not passive. So if you're passive, it's not an issue.
Doesn't matter.
It's only if you're active or, a real estate professional, or just if you're in any business. Just remember that, and that really applies for any business. If you have a bad year, don't stuff more deductions in that year and create a greater loss. It doesn't help you anymore. Before it didn't matter, now it can hurt you. You try and spread it out. It's like a balancing act.
Gotcha. Yeah, because that can change some of our tax strategies for our syndication as well. Now, just want to clarify that too but the cost segregation study can actually happen even well into, let's just say, 2023, well into like March. Don't want to push it too far. As long as before you did your tax filing, essentially.
Yeah,
Right.
yeah. So that actually brings up a really good point that a lot of people don't realize, which is when you do a cost segregation study, you don't even have to do it for the first year you acquire the asset. Really, what a cost segregation study is it's like a catch-up. So you could do, if you bought an asset in 2020, you could actually implement a cost segregation study for the year 2022. And so what that means is that you basically are calculating the depreciation you did take without the study for those 2 years, and then you're recalculating it under the cost seg, and you're getting a deduction for the difference. And so that is really important to understand, because that's what helps you time things. You don't have to worry about, oh, I bought the asset this year, so I have the deduction. No, you can wait until it makes sense where you have income to offset and take the deduction in that particular year. And then, like you're saying, Elisa, as long as you have the study completed by the due date of the return and when it's filed. So 2022, if you extend the return, you have until September for a partnership. You file timely March 15th to get the study completed. So yeah, that's an important part. And the depreciation rules are based on the year you bought the property. So with bonus going down, if you bought a property in 2022, but you don't do a study until 2023, you're still using 2022 100% bonus depreciation rules. So you're not missing out from that.
Yeah. So that kind of helps in giving you a little bit more expanded time if you're thinking about doing cost segregation. Because if you listen to this webinar and then you're rushing to our good friends at Medicine Spec or other cost segregation team, also I think Eric's term does that too. You may not get into the queue, but no big deal. Like, you actually have more time than you think you do for that. Yeah.
Yeah. And it's important. I would, if you're doing any cost segregation studies on your own for your own properties, I think I've worked with Madison Spec before and haven't had any issues. We do cost segregation studies, but you want to work with the CPA that is preparing your tax return too, on whether it makes sense to do one or not. Like, don't just assume it makes sense or doesn't make sense. Hopefully you have someone that knows the area well enough that they can advise you, because I tell people all the time, no, don't do it this year, wait, or yeah, you should definitely do it this year. Like, timing can be important on those.
Yeah. And of course, as a syndicator, there's only one way to do things versus various way to do things. So there's based on our schedule, that there's expected by investor, which often sometimes means we may not be able to take some deductions that's on the table. But that's probably the right trade-off. Okay, cool. So moving on from that question, we got another question over here. How can I save my negative K1 passive income with positive K1 gain from syndicated investment? I think we kind of touched that on the question too. So the answer is yes. You probably just have to collect all your K1s and give you to your able CPA, so that they can just do it. And then if you have pushback from your CPAs on this, which actually, surprising or not, we get investors ask that question all the time. And it's till to my surprise, some of the CPAs they deal with are unfamiliar with this, and then they refuse to do that for them. Now, everybody's personal situation is different. There may be a reason why your CPA decide not to do it, like Eric has shared before. So that tee it up to really good questions on, right? That's all they needed to do as a passive investors. You literally just gather all your K1s, because you're going to get a positive one and a negative when you give it to your CPA. Your CPA should just take care of it, right?
Yeah, hopefully that should be the easy part for the CPA, right? Is figuring out that aspect and figuring out, I mean, if you are the only complicated when it gets, if you're passive in everything, it's easier. If you have some active and some passive, then it becomes it takes a little more analysis sometimes.
Yeah. When you say active means deals that you put material participated in, right? That's what you mean.
Right, exactly. So
Yep.
if you were like the part of the general partner on a deal, or you had your own small investment that you were active in, and then also the syndications, then it would apply in all those situations.
Okay. But if you have a rental and that's a passive investment, meaning you own it, that's still a passive income, wouldn't it?
So it depends, like always.
Or capital gain, sorry.
Yeah, so it depends. So by default, all rental real estate is passive, but there are two exceptions. One is the real estate professional that we talked about.
Okay.
And then the second one is what they call active. active real estate. And what active real estate is essentially if you are part of the day-to-day, essentially, like you manage it. That's
Yep.
kind of the basic way to put it. So and when I say you manage it, that could mean that you hire a manager who does it on your behalf. But
Mhm.
ultimately, at the end of the day, you are still making the major decisions, um, with the
Like someone
manager.
like me. Yeah.
Yeah, exactly. And so that then you could be active. So if you are considered active, then you can offset up to 25,000 of your other income. So wages, interest, dividends, other business income, whatever it may be. But that starts to phase out. So once you
Mm.
hit above 125,000, it starts to phase out dollar for dollar. So in other words, if you make 125,000 or less, you can have 25,000 of active rental real estate losses and offset that income. So, but once you get up to 150,000, you no longer get any of that active rental real estate to offset your other income.
Mhm.
So that's kind of the downside of that one, is that it's fairly limited. It phases out pretty quick. I mean, you're still like lower middle income when it starts to phase out. So it's not, a huge benefit, but it is when you're first starting out. And then the other exception is the real estate professional that we talked about. Then you can take losses and offset your other income.
Yeah, so passive losses can now offset your active income, the ordinary incomes over there. So one is limited and the other one's not limited. It's actually better. Okay, cool. So how do I know then what question to ask my CPA? Let's use one investor's particular scenario. She gathered all the K1s and sent it to the CPA, and the CPA said, "Oh, you can't offset the losses to the uh income." What questions should she ask, and what particular chapters that she needs to remind the CPA to look for?
Yeah. So, I mean, the thing is that for real estate, it's a huge, huge benefit owning real estate from a tax perspective. But that doesn't mean it's like a magic pill that, everyone all of a sudden doesn't pay any tax, right? You have
Mm.
to still have the right structure and investments. And if you're just 100% passive, you're probably not getting all the benefits. You're still getting benefits because you're still maybe not paying any tax on that income with
Mm.
depreciation, and you may still get cash flow distributions from it. So it's not a bad tax outcome, but it's not like it's not like you hear, Trump and a lot of these others saying, "Oh, I pay zero tax." Well, they spend like, all their time in real estate. So it's just a completely different situation, right?
Mhm.
But to kind of go into what you should ask your CPA, number one, I would make sure that you're working with someone that kind of specializes in whatever area, or at least understands the area that you are focused in. So if you are very heavy in real estate and real estate syndications, make sure you're working with someone that actually understands these
Mm.
passive rules. So things you can ask them is just give them buzzwords, like passive, active, real estate professional, and see if they can talk about it, what they say. Are they just kind of like, "Oh no, it doesn't apply," and they don't really give you an explanation? Then maybe they don't understand the rules, or they're not looking close enough. But if they actually give you an explanation and why maybe it does or doesn't work in your case, I think that's a pretty good indicator of
Mm.
whether you're working with the right person. And then I would also make sure that the one mistake I think some people make is thinking that, you can do whatever it is throughout the year, make whatever investments, start whatever businesses, do whatever in there, and then you get to tax season and the CPA is just going to work some magic and get you the numbers that you want to hear. But that's not the case. You have to be proactive and tell them what's going on throughout the year. So tell them if you're making a new investment, tell them if you're buying a new property, tell them if you're starting a business, tell them if you're thinking about a big asset purchase, and give them the opportunity to tell you what their take on it is. You know, for example, if you're thinking about buying some new equipment for your business and it's already November and December, then one of the questions may be, hey, should I just wait until January? And that can make a difference. Or vice versa. I was going to wait until January, February, but I'm going to buy it anyway. Should I just do it this year? You know, I'm going to invest in this real estate syndication. What can I expect from this, so that they can let you know ahead of time what to expect, so you don't go into tax season you know, being blindsided or feeling blindsided because you weren't aware of it. It's a two-way street. Keep that communication open. That's really important. The last thing you want with your CPA is you only hear from them once a year at tax season when they hand you their return, right?
Yeah. Yes, absolutely. And then that's always an ongoing conversation with my CPA or my CPAs, because I have multiple on this. This allows me to kind of compare. You know, someone said this the best is like, well, you're not gonna go with the first bids that on your roofing job. You usually get 3 bids. Why would you go with the first CPA? So maybe talking to a couple of them before you decide it would be a good idea as well.
Yeah, and referrals are always good too. If you know, if people that have had good relationships, then that's always a good place to start.
Yeah, definitely. Okay, so someone has this question back into the REAP status, which is the real estate professional status. Because we do have some content on our blog. Obviously, disclaimer, we're not CPA. It's just numerous conversations that I had with CPAs like Eric lead us to understand some of these knowledges and whatnot. So as real estate professional, someone who has that status, can active income be offset by passive real estate income, such as LP, limited partner, syndication participation?
Yeah,
I'm
no,
assuming they're talking about negative K1s that generated by the participation into syndication as LPs.
yeah, no, that's a great question, because that kind of goes back to what we were talking to a little bit at the beginning with the grouping. So just to explain it a little deeper, not only do you have to be a real estate professional, but in order to be non-passive, you have to also materially participate in each activity. So that means for each rental that you own, you have to materially participate. And there's a set of criteria set by the Treasury. And I think there's like 9 different ways you can qualify as materially participating. The go-to like gold standard is you spend 500 hours in each activity, but a lot of people aren't going to meet that because either you're hiring out property managers, or frankly, it doesn't take 500 hours to manage a single family residence in 1 year.
Right.
So instead you go to other tests, which maybe one of them is you spend at least 100 hours and more than anyone else in the activity. So there you're looking at, if you're the only one doing everything and you spend 100 hours, then that's pretty clear. If you start having partners or other employees or other people that are involved in the management, then you have to kind of track their time. So anyway, the grouping becomes important because in a syndication, you're probably not spending any time, really. You're writing the check and then collecting checks, hopefully, right?
Right.
So the trick is that there's a special election for real estate professionals where you can group all of your rental activities as if it's one activity. So in other words, if you are a real estate professional and you have rental real estate, so let's just say you have a bunch of duplexes that you manage and then you invest in a syndication. Well, you probably, between all of those duplexes, you probably meet the material participation if you're active in some way.
Yeah.
But the syndication, you probably don't. So you elect to basically say it's all one. And then it kind of pulls that syndication in and you can offset that income But without that election, you can't, because that syndication would be passive.
Right. But it could potentially offset or defer. I like to use the word defer because taxes due at some point. Um, for example, if you had a passive investment, like you own a single family home, you sold that single family home, there's a capital gain. That's passive, right? And then possibly if in that same year, somehow you generate negative K1 from your passive investment through a syndication, etc., that is potentially deferrable.
Yeah,
Right.
well, as long as as long as that single family home was actually passive, if you were active in it, maybe it wasn't, or maybe if it's your own residence,
Right.
then
That does not. Yeah.
but your own residence, you're even better off because you still have there's an exclusion from income, right? So
Right.
married filing joint, you can exclude 500,000 of gain
Right.
when you sell your personal residence.
Yep.
But you have to live there for the last 2 out of 5 years in order
Right.
to get that. And that's a big one. I've seen people miss that by like a month or two, and it's sad because
It is.
that can be such a big difference in your tax bill.
Yeah. I bet.
Uh,
Yeah. Huge difference. Um, and then the REAP status, yeah, like we kind of talked about now, how to qualify. It's definitely a question you should ask your CPA because there's not a one size fits all over there. We've seen all walks. Some of our investor ask us. We always emphasize on we're not CPA. You absolutely have to go check with your CPA before you make these investment decisions, right? Because you don't want to make them and then come back and find out that doesn't qualify. You want to have that during the years where it's correctable. Um, cool. And then so the other thing, as Eric kind of mentioned over there, other ways to kind of get into that is if you participate in syndication, let's just say you co-sign a loan and you're actually doing other duties as general partners in a syndication, you may not need to be the main sponsor, but if you had a main um couple of these deals that you participated in and spend hours on, maybe one single one wouldn't get you 500 hours, but if you did like 7 or 8, then there's a better justification that you spend all these hours over there. So these are different kind of ways, kind of creative to think about it. Other ways I want to kind of share, this is where I'm going to verify with Eric over here too, is what if I was doing a flipping and hold? Now, would all my hours spent in flipping, supervising constructions and this and that be counted towards my real estate professional status?
Yes, yeah, it should be because you're kind of, so the terms that they identify specifically are, those construction, development, property management, brokerage, and you're definitely touching like construction some there,
Mm.
because it's a flip. It's pretty
Sorry, fix,
clearly,
not flip. Yeah, flip
yeah,
implies sell right away. Yeah,
yeah.
fix and hold. Yeah.
Yeah, fix and hold, then you're still doing that construction piece and being an owning real estate counts. So like construction could mean like you're a contractor
Mm.
but you're building, real property. But owning real estate qualifies, managing real estate qualifies, all of those activities qualify. And then there's some other questionable things that are defined through basically case law, where people made the argument they were a real estate professional and the IRS either agreed or disagreed. So one of those was like appraisers, real estate appraisers. I think those qualify under one of the court cases. Appraisers qualify, but lenders do not.
Mm.
um, and kind of a weird distinction because they're kind of both tangent to real estate.
Yeah.
So I don't really know offhand why that determination was made, but those are clearly in like court cases. But there's things that are not as clear too. But being a
Yeah.
fix and hold, owning real estate, that one's pretty cut and dry.
Got it. And then now if you fix and hold, I'm just gonna ask this question is like, how do I become a real estate professional from owning a single piece of property, single family home? I'm guessing like fix and hold, and on top of it, if you ran Airbnb, would that qualify? So you're managing and hosting Because a lot of, especially with the new piece of news that's coming out now, with Airbnb is now pushing for landlords to incentivize landlords to actually letting other people more hosting their units, making that more friendly. I'm sure there's more people thinking about that way. Yeah.
Yeah, you know what? You know how I said earlier that I didn't really like the term loophole used in most of the time when it comes to real estate? Airbnb actually, since you mentioned it, this might be a loophole because I'm not sure this was actually intentional, but this is the law. Is Airbnbs are a special category because they don't always fall under the same real estate rules. An Airbnb, if it's rented for under 7 days on average, then it's not defined as a rental activity, which means it's not passive by default.
Mm,
So sometimes if you have an Airbnb, it may not act, you don't have to be a real estate professional. You still have to be materially participating.
right.
So maybe you're doing the bookings and things like that, but you're hiring someone to go in and do the cleaning. And so
Yeah.
you could be a material participating, or you could be active in it, have material participation, but you're not a real estate professional because maybe you have a day job and you're doing other things.
Yeah.
But you would be able to offset that Airbnb income with your other income. So that is one little nifty trick that people are finding out. The catch 22 on that is that on the opposite side, if you have positive taxable income from an Airbnb and you're providing a lot of additional services, so think closer to a hotel. So I mean, there's some Airbnbs that maybe they give you a bike to use to get around, or they give you
Right.
coupons for Ubers or something, or they give you, it's on the beach and they give you volleyball court and some volleyballs and all these other like things that
Mhm.
are not just a room to rent.
Yeah.
Then it may be subject to self-employment tax
Mm,
if you have income, which is an additional 15.3% tax that you have to pay on top of your income tax. So that's kind of the flip side of Airbnbs can be better in some ways and they can be worse in some ways, because
mm,
true rental real estate is never subject to self-employment tax. So you don't run into
yeah.
that issue there. So
Yeah.
just a little tidbit that I wanted to throw out there since you brought up Airbnbs.
Yeah, yeah, definitely. So again, that would be an activity, maybe something to explore to qualify you at REIPs if you're thinking about just only investing one or two single family home because that's all you can afford to buy. There's some ways to kind of explore, but definitely check with your CPA on this to qualify. Just different ways to kind of rack up some hours for that. Cool. Next one is, what limits are there to use depreciation for future years to offset income as a real estate professional status?
The biggest one is probably if you're a real estate professional, then you can pretty much offset any income, your regular wage income, your spouse's income, all of that.
Mhm.
But you run into that net operating loss issue that we were talking about earlier. That's one reason you don't want to generate too many losses. But the other thing that is starting to I'm seeing hit some of our clients is what they call the excess business loss limitation. And this was a new something that Trump also passed, but we had some deferrals of actually implementing this because of some of the COVID laws that came
Mm,
out over the last couple of years. So
right.
now going into 2022 and forward, this is going to be a bigger issue. And so what this is it basically says that you cannot offset more than, I think it's 540,000 of income for married filing joint for
Mm,
2022 with business losses. So in other words, like the cases that I've seen are maybe the spouse is a doctor and has a high wage income, and it's and whatever it is, it's 600,000, 700,000, and
mhm.
then the husband may be a real estate professional, and so their full-time job is just investing in real estate. Like one example I have, he's a commercial real estate investor, And that's all he does day to day, manages it, buys it, he does everything. And but if they have more than 540,000 of losses from the real estate from doing cost segregation studies and things like that,
Yeah.
they can't offset the full wage from their spouse, or if they have other, interest in income or dividend income from brokerage accounts. So in that example, if you had 600,000 of income, you only offset 540, you're still paying tax on $60,000 of income. So that's something to keep in mind if you have one spouse generating a lot more income, or you have other, high brokerage accounts with capital gains and other things that are not from your business.
Yeah. And then just a follow-up question on that particular scenario. If your taxable income was 60,000, and that's taxable income, right? So your tax bracket would be calculated based on $60,000, or would it be calculated based on $600,000?
It'd be based on the 60. So you'd be in lower brackets, especially married filing joint. You're probably, I don't know, paying an average of somewhere between 10 and 15%
Yeah.
on that. But that's more than you would have a few years ago, right? You would have been
Yeah.
paying nothing. So, and something to pay attention to, because, stocks and the market have been down, this year pretty heavily, but
Yeah.
it's still higher than what it was, if you had invested 5, 6, 7 years ago. So if you're thinking about liquidating in stock investments, that counts as income you can't offset, that may be subject to this limitation. So in other words, just to drive it home, if you had a wage of 200,000 and
Yeah.
then you decided to liquidate your stock investments and you generated a gain from your stock investments of another 400,000 of gain, so now you have 600 of income still, you're still subject to that limitation because that stock sale is not business income. So that can be something that might catch some people, especially as we kind of wonder what 2023 looks like.
Yeah. And then for stock gains, are they counted as passive income? In other case, does that mean if you're liquidating stock and reinvest it into syndicated deal and generate a negative K1s as passive losses, would that have material impact with each other, or do they not interact? There's some limitations to that.
Yeah, they're separate, unfortunately. So capital gains from a stock sale are generally what they call portfolio income. So yeah, you couldn't offset a passive loss from a syndication investment with a capital gain from a stock sale. If you have a capital gain from another syndication, you can, because that is passive activity. So there's a difference from passive and portfolio. Portfolio, just think of capital gains from stock, it's interest, it's dividends, all those things are portfolio income. So those are not considered passive.
Gotcha. Cool. That's great question. Great insight into that. Is there anything new for 2023's tax season for small net rentals, single family, duplex, triplex?
So I think it's
Other than the bonus depreciation that we have touched on.
Yeah, I would say probably nothing that we haven't already touched on. So yeah, you're right. The bonus, the LLC filing requirements that we talked about, the energy credits, if any of those apply if you're doing upgrades, and then everything else that we're kind of talking about is not necessarily new for 2023. This is existing tax law. So I don't think there's any substantial change to be concerned about or excited about on that front.
Got it. Awesome. And how does taxation changes for California investments if we move out of California or out of country? In other words, can they escape the clinch of California?
So I'll talk generally about
Mhm.
states, and this will apply to California. So this could apply to anyone. But generally, the state wants to tax the income sourced from that state. So in other words, you have to determine whether the income is sourced there. So for example, if you own real estate in California, say you have a rental property in California, moving outside of California while you own that rental does not escape California tax or any other state tax, because the rental is actually physically in that state. The income when you sell it and the income from when you are renting it is all sourced to California. So you would basically be filing and reporting California non-resident tax return in addition to if you move to a state that had income tax, you'd have to file there as well and potentially get a credit for paying tax in one of those states. So versus income that is not sourced that way. So there's some income that's sourced based on your home state. So that would be like just general interest income from like federal bonds or something, or like dividends from the stock market, or capital gains from the sale of stock. Those items are sourced to wherever your home state is. So if you were paying tax in California based on those, you move out, now you're paying tax in the new state that you move to, or if it's a state that doesn't have income tax, then you're not paying state income tax on those items. So it depends on the type of income that you're generating. And essentially very similar rules apply when you move out of the country. Obviously there's nuances and it's a little different, but it's the same concept for the most part. Anything sourced to the US, you're paying US tax. And if you're still a citizen, or you have a green card, or you're considered a US resident, you're paying tax on all of your income, worldwide income. So moving out of the country, unless you renounce your citizenship, you're basically still paying tax on
and green card apply in that case too, right?
Green
If I
card
was not a
applies.
citizen,
Yep.
but a green card holder because you're a
that
resident.
applies too. Exactly. So yeah, you'd have to renounce your citizenship to get out of the clutches of the US on your other income, but you're still paying tax in the US. And there's an exit tax for doing that as well.
That makes sense. Great. Yeah, because I've just heard these. I'm glad never lived there as a main state, so I don't have to worry about this. But I do know a lot of our investors are from California and are looking for ways to kind of get out of these duties or burdens. Also, another note over here I want to note is if you have had a syndications getting that sales completed this year or last year, you want to make sure that you actually filed a state tax return for the state where the property is sourced in. We've had a lot of run-ins with our investors. Some may even made a comment on like, hey, we have invested in 10 deals all over the state and nobody ever asked us and told us that we need to file state tax returns for states that has income tax. There's other ways to get around it, such as composite return, etc. We're not going to get into detail on that. So if you have never heard about composite return or file on your behalf from your syndicator, then you are most likely responsible for filing that state return for that particular deal that has went full cycle. So something to kind of note it on. And then we have sent out some communication on our end, because one of the first deals that we have invested in Arizona, we deliberately decided not to do composite return just because our tax firm doesn't support it. So for these type of investments, our investor is responsible for that state tax, which could be pretty easy by just going to TurboTax and get that done. But still something that you need to file and ask your syndicator about. Okay. So, how does taxation? So next question, if you sell or finance a property, can you do a 1031 or will you have to pay tax capital gains? It's a odd one. Never had that one. So
yeah, that's pretty involved, but the basic answer is being the seller and having a note. So the buyer now owes you. That's what we call boot in a 1031 transaction, because the note that you hold is not like-kind property, nor is it real estate. So it wouldn't qualify. There are some planning ways to get around that, but they are that gets into some pretty advanced planning.
Mhm.
And sometimes you don't see it happen very often. Generally, what happens in those situations is you're treating it now as an installment sale, which means
Mhm.
that you're picking up the gain from the sale over time as you receive payments on the note.
Mhm. Got it. Because the seller financed the property, and oftentimes that's not a real estate anymore. It is basically a note that you carry, or they carry the note to do that. It really kind of case by case, because seller finance is like totally wild, wild west. Depends on how you how you do this. Has a different implications for that. I guess the other question I have, because it's a note, therefore, if you do receive K1s from your involvement as LPs and syndications, negative K1s, that negative K1 also is not applicable, right? Because note is a different type of investment, uh, not a passive investment, can be offset by
Right.
passive loss.
Yeah, you would be considered the interest on it, on that note that you're receiving, would be portfolio, so it's not passive. If you were part of a syndication or a passive partner in someone where they did a carryback, then the capital gain you're recognizing over time may be passive and be able to be offset by
Mm.
some of those other K1s. It just kind of depends. But if it was something you were active in, then and that was your own property and you're doing the seller carryback by yourself, then it's probably not considered passive.
Mhm. Yeah, because I do remember there is a particular property which we sold, and it was a seller carry, but it was seller was actually lending to us, but is giving us deed for that. So it is considered real estate transaction because transaction is actually recorded. And then the seller then turns around and lend us the money. So that's slightly different structure that way, and it's for all intents and purposes is a traditional transaction, except that the seller in that case carried the note. So the seller, obviously, to him, there's still capital gain involved, so no difference to that. That's just simply facilitate, you know, the transaction. Allow the trade off is he gets a higher price, but the turn for us is actually better because we pay actually less monthly fee. There's reasons for that. So I think in that it's just a regular old transaction, but for the seller himself, he on that year has sold the property, so therefore is responsible for the capital gain. Yeah. Okay, next one, how to minimize capital gains or offset capital gain without needing to do 1031 exchange if plans to sell rental properties. We kind of talked about a little bit before with cost segregation. Now the challenge with that is cost segregation, typically even a seller depreciation only generate a X percentages of what you invested in. So it may not be able to do like 1031 exchange, like 100% gets deferred if the purchase price is higher and you reinvested the whole amount moving forward. So the portion of it may be a little bit smaller. But any other ways to do so, Eric?
The other things, I mean, there's opportunity zones. So investing in an opportunity zone or a syndicator that has an opportunity zone investment, that is one way that people were deferring a lot of gains over the last few years. Installment sales, which we just talked about. So if you do a seller carryback, recognizing it over time, which may mean you're paying at a lower tax rate too, because you're not pulling it all in at once. The higher your income in one year, the higher the tax rate you're paying on a lot of that. So that can make a difference. And then the other thing, this, I saw another question, I think, about this, but there's this thing called deferred sales trust. I won't go too much
Yes.
into it,
Yes.
just because it can get a little nuanced. But basically, what that is if you don't have a 1031 lined up, you sell it essentially to yourself, but really it's a trust. So you sell it to this trust that then gives you, that then you basically owe, the trust owes you money. So it's like an installment sale with this trust. So you sell your property, and then the trust gives you a note in place of that sale. And so it creates this installment sale. And what that does, the benefit is that basically you don't recognize the income yet because you are selling it on installment sale, and then the trust then can invest the proceeds, and you can trigger that note payment based on when you set up a payment and you say, it'll be 5 years and we'll pay it off at the end of that. So you defer that gain, or maybe you recognize it slower over time, and you don't need a third party to, the trust is a third party because it's with a trustee, but it's not really a third party, right? It's not another person. So that's one strategy that some people use, but that definitely gets higher in on the planning. If you're not going to invest in more real estate and you don't have a long-term plan with it, I don't know that it's always worth it. Sometimes it's worth paying the capital gain if that's what makes sense, so that you're free and clear of having your hands tied and you can do whatever you want in terms of an investment with that cash. It just kind of depends on that long-term plan.
Gotcha. Yeah, because I think that was discussed and it was very difficult for me to understand. So that warrants itself a whole session. We did have some interview in the past around this, but I think more like a 201 level of dive deep into is needed for that particular vehicle. How do I write off a down payment? Is that even like a possibility?
No, not the down payment itself. So everything is, so if it's a business property, so like an investment you make, then you're taking the depreciation, which is based on the entire cost of that asset. If it's your personal residence, then you don't take any depreciation. It's not eligible for depreciation. So in that case, you're writing off the interest expense if you have a loan, then you're writing off the interest expense, which you can take as a personal residence or as business property. But the down payment itself, you're not writing off. You're only recovering that if you can get depreciation as a business.
Yeah. Okay. Okay, cool. So I think we're kind of almost at the top. I'm gonna ask maybe one or two last questions over here. One that I'm really curious, really quick questions. Is there any updates on OZ funds, given that it's pretty much phasing out at 2027 tax year? I think we're down to the 5-year mark now on this, I'm guessing. So a lot of the good benefits are already gone. So is there any update on news on that?
Yeah, so nothing has changed, but just to back up on what date we're talking about. So if you invest in these OZ funds by the end of 2026, then you can get the benefits. After that, no new investments can be made. And any investments that you did make, the deferred gain on that investment comes due that spring of 2027. So if you want, more information, OZ funds can get a little nuanced. So if you're not already aware of what these are, there's a lot of resources. I've done some other talks and materials that I can share with you to educate you a little more in detail. But essentially, there's nothing new on those. We had COVID extensions for the last 2 years, but nothing new is happening. It's probably not going to get extended. These dates probably won't change. There's nothing out there. The only thing that's been out there is there are some people that wanted to repeal it, but that's not going to happen. So it kind of is set to what it's going to be at this point, unless we get closer to that deadline and someone decides to extend it.
Yeah, which is too bad, because I do think the OZ project did transfer some of the neighborhoods that's in the privilege. Is probably one of the best things that was done during that era. That's kind of my personal opinion over there. The other question I have, the last one, really kind of interested, just so to ask the question, because I don't even know what these terms are. The DSTs and the CRT tax saving examples. I'm assuming DST stands for deferred because there's two DSTs over here, right?
Yeah.
The DST can be Delaware Trust, Delaware Statutory Trust, which is used for a 1031 exchange vehicle, or it can be a deferred sales trust, which is something that Erica has mentioned before. I do not know what CRT stands for.
Yeah, so I'm guessing that the CRT stands for, in this case, charitable remainder trust, but I'm not
Uh,
sure if that's what it is or not. But yeah, we just covered, if you're referring to deferred sales trust, then we talked a little bit about that, and like Elisa said, that gets pretty involved to go further. But I mean, basically, that's a deferral strategy. And then Delaware statutory trust, if that's what it means, that's really a 1031 vehicle. That's just a way to 1031, because you can't 1031 property own into a partnership interest. It has to be
yeah.
real estate for real estate. A Delaware statutory trust is basically a way around that, because a Delaware statutory trust basically operates very similar to a partnership, but it's not. And so that's been a way to facilitate 1031s and get into syndications, is you'll invest into a Delaware statutory trust. A charitable remainder trust, that's really gets pretty involved, but the basic premise of that is, if you truly want to give to a charity when you pass away, your estate, you can use a charitable remainder trust, which basically is, you give a lot of assets to this trust, potentially you get a deduction for that, and then while you're alive, you or your beneficiaries may get some income from those assets over your life to sustain you. But then when you pass away, all the assets remaining go to the designated charities and beneficiaries. So it's really a tool to give and get a deduction now while kind of sustaining your life. But you have to have true charitable intent for that, because it's truly giving away assets.
Gotcha. Thank you for that. Yeah. And then I think we're almost over, like over here. I think we're actually a little bit over the time over here. I did have some questions, live questions over here. These are pretty simple. One of them, I don't know if it's a joke or not, but one of them was, if I renounce US citizenship, can I stop alimony payments? I think that is beyond our session knowledges on taxes.
Yeah.
I'm thinking.
That's not necessarily a tax issue, right?
Yeah, on that note, yes. And I think one is very interesting, also dear to my heart, because we're kind of discussing about budgeting and all that sort of stuff. At some point, a business owner become a W-2. Potentially it may, for other reason, may make sense to pay a W-2. So when you're thinking about it, specifically my CFO likes me to take a W-2 because it's more manageable and better for budgeting when I'm being paid a fixed rate. So the question there is, like, I have an S corp as a business. Should I pay myself a W-2, or is it better to withdraw as passive income as distributions? What's your opinion on that?
It always depends. So, I mean, there's just a lot of, you need to know all the circumstances to really make a determination, because S corporations are required to pay what they call a reasonable comp. So that means basically paying yourself what a third party would expect to be paid if they were doing what you're doing. So
Yeah.
that's like rule, basis number one for an S corp. And then you can get into, from there, you can get into all kinds of planning. Whether it's maximizing your qualified business income deduction, which was that 20% deduction we're talking about. Wages don't count, but the other flow through income from the S corp above and beyond wages does count. So from that standpoint, you're better paying less W-2, but you still have to pay a reasonable comp. And then there's self-employment tax issues. You pay self-employment on your W-2 income from it, but not from the other pass-through income from the S corp. So really, it's taking all of these things that you have to balance, what the IRS allows you to do, and then coming to a conclusion. So it's really something that definitely want to know, talk to your CPA about it. because you don't want to do the wrong thing. That's an area that gets audited sometimes. It's an easy thing for the IRS. If you don't pay any wages from an S corp that's making a lot of income, the IRS targets that a lot of times from a reasonable comp standpoint.
Which is actually begs another question, which is like that's always an ongoing conflict, or not conflict, but discussion I have with my CPA from a personal tax is, at what point does it make sense to go S corp? Because majority of the business we do is real estate. There's a huge amount of deductible, but turning into an S corp can potentially avoid or reduce the self-employment tax. So that's always something that we waited on. So that would be a question I would ask your CPA further on that. Last question we have is, using HELOCs to fund the syndication as LPs, how would you structure the investment to be able to write off the HELOC interest other than using personalized deduction option? Because SALT limits in my state, I don't know what state has SALT limits over there. Maybe you can shed some lights on this one.
Yeah, so I think so they're talking about state and local income tax limits. So that was part of the Trump's tax plan also. You can only, when you itemize your deductions, so itemized deductions are your interest expense, your income taxes and property taxes on, property that you use personally, and then charitable deductions. So Trump's plan limited the state income tax deduction to $10,000. So states with higher tax or higher income people were severely limited on their itemized deductions. And then having home mortgage interest also was potentially limited, because they reduced the home mortgage interest. Used to be able to write off home mortgage interest on $1 million or less.
That's right.
And it got reduced to 750,000. And then there were some changes to HELOCs as well. So there are all kinds of changes there. But essentially, what you want to pay attention to is the interest tracing rules. So the IRS says you trace interest. So if it's not deductible, if it doesn't have to be deducted as your primary residence, which HELOCs generally you don't have to treat as personal interest if you used it in somewhere else that makes it deductible somewhere else on your tax return. So by investing in a syndication with those proceeds, it now becomes, it depends on what type of syndication is, but if it's rental real estate, it now becomes deductible against that K1 activity, the interest. So you would trace it to that activity. But you have to, if it ever got audited, of course, you'd have to show that it was actually traced there. So showing deposits and then transfers and kind of supporting that. But essentially you can back that up and deduct it somewhere else on your tax return, because it's always better to get it off your Schedule A, which is itemized deductions, and deduct it as business or rental real estate or somewhere else, because it's subject to a lot less limitations.
Yeah, that's fantastic. Well, on that note, thank you so much, Eric. We're almost spent the whole night over here by ourselves, and there's still additional question that would be coming. But hopefully, if you give us a thumbs up, if you think this is a great session, we're definitely going to be distributing this through recording. And by the way, Eric, we never asked this. How do you find more information about yourself and all these like knowledgeable? I understand that you have a YouTube channel that you want to get started on these two. Like, how do you actually get plugged into all these knowledge base over there and actually do spend a whole night with him?
Yeah. You probably don't want to spend the whole night with me on taxes, but yeah, there's a lot of resources. So I'm glad you mentioned it. So I have a new YouTube channel, so you can find it. Just go to youtube.com/@EricFreemanCPA. And you'll find it. There's not a video up right now, but starting in January, they will start going up. And then, of course, you can find me on all the other media platforms. And then as far as, so that would be more education. So diving deeper into some of these topics, if you want to learn more, it'll be there. And then as far as if you need help with your taxes, then you can visit my firm that I work with, which is BeachFleischman. And it's, beach, like I'm going to the beach, and then Fleischman.com. and we can help you with any tax planning and things like that. So just depends if you want education or potential help, but there's tons of resources, and happy to help educate. And hopefully you found this useful, and maybe we can do it again sometime if there's more questions.
Yeah, definitely. And then you can definitely look him up. He's somewhat famous. You can find him on YouTube channels, interviewed by other people as well. There's some really great session he's done for Kenny Macro as well. So that would be really great to kind of look at through some of his presentations over there too. Well, thank you so much, Eric, for spending your time with us today. Hopefully everybody got what they needed over here. And for some of you guys are consuming the recording, this will be available on our YouTube. And looking forward to have you guys coming back next month on the webinars, and sign up for our next month webinar. I think it's going to be a fun episode because it's going to be Christmas time. I'll be down in Kabul. And it's probably has something to do with international investments. So yeah, looking forward to do that. And definitely find Eric on LinkedIn. It's probably a good place to find him. And also we're going to put our links in our YouTube notes over here, and then our recording notes as well. So you don't have to remember his website. You can actually find it. Yeah. All right. Thank you so much.
Yep.
Yeah.
Thanks for having me, Elisa.
Awesome. All right. We're logging off tonight, and have a great evening. Yeah.